The British economy is one of the world's largest and most advanced, with a GDP of approximately £3.1 trillion in 2023, making it the sixth largest globally. The UK operates as a mixed market economy, combining elements of free market policies with government intervention in sectors like healthcare and education. A distinctive feature of the British economy is its openness to international trade and foreign investment, facilitated by its strategic location and historical ties with various countries. London, in particular, plays a pivotal role as a global financial hub, with its stock exchange being one of the largest and most influential in the world. Despite facing challenges such as Brexit and the COVID-19 pandemic, the UK economy has demonstrated resilience, adapting to new global economic realities while seeking to maintain its competitive edge. The roots of the British economy can be traced back to the Industrial Revolution, which began in the late 18th century. This period marked a major shift from an agrarian-based economy to one focused on industrial production, with Britain becoming the birthplace of modern industry. The advent of steam engines, mechanization in textile production, and advancements in iron and steel manufacturing revolutionized productivity and laid the groundwork for rapid economic expansion. By the 19th century, Britain had established itself as the world's leading economic power, dominating global trade and colonizing territories to secure raw materials and markets for its goods. This historical context is crucial in understanding how the UK's economy evolved into its modern form, with global trade networks and industrial legacy continuing to influence the country today. In the contemporary era, the UK economy is highly diversified, with several key sectors driving growth and employment. The services sector is by far the largest, contributing over 80% of GDP. Financial services are a major part of this, with London being a global center for banking, insurance, and asset management. The technology sector is another growing area, particularly in digital innovation and fintech, with the UK home to a burgeoning startup ecosystem. In addition, the healthcare sector, supported by the National Health Service, NHS, remains critical, not only as an employer, but also as a driver of public investment. The creative industries, including media, entertainment, and advertising, are also important contributors to the UK's GDP. Meanwhile, manufacturing, though diminished from its historical dominance, still plays a key role in high-value sectors like automotive, aerospace, and pharmaceuticals, contributing around 9% to the nation's GDP. This combination of traditional and modern industries gives the UK economy a dynamic and adaptive character. The Industrial Revolution, which began in Britain in the late 18th century, fundamentally transformed the country's economy, shifting it from agrarian-based production to industrial manufacturing. Innovations such as the steam engine, mechanized spinning, and the power loom revolutionized industries like textiles, coal mining, and iron production. By 1850, Britain had become the world's leading industrial nation, with manufacturing output growing exponentially. For instance, cotton textile production surged by more than 500% between 1760 and 1830, cementing Britain's position as a global economic powerhouse. The revolution also spurred the development of new transportation infrastructure, including canals and railways, facilitating faster and cheaper movement of goods and raw materials. By the mid-19th century, the industrial sector accounted for around 40% of Britain's workforce and more than half of its national income. As the 20th century progressed, the UK economy began to shift from manufacturing to services. By the 1970s and 1980s, deindustrialization set in, particularly in traditional sectors such as coal mining, steel production, and shipbuilding. Factors such as global competition, automation, and the decline of Britain's colonial empire contributed to this transition. The economic restructuring during this period saw the rise of the services sector, which grew to become the dominant force in the economy. By 2023, services accounted for over 80% of the UK's GDP, with finance, education, healthcare, and retail leading the way. London became a global financial center, attracting international banks, hedge funds, and multinational corporations. In contrast, manufacturing's contribution to the economy fell significantly, accounting for just 9% of GDP and 8% of employment. Despite this decline, sectors like aerospace, automotive, and pharmaceuticals remain globally competitive. The long-term impacts of the Industrial Revolution on growth and employment are profound. On the positive side, it laid the foundation for Britain's modern economic success, creating a legacy of innovation, infrastructure, and global trade networks. The revolution also initiated a period of sustained economic growth that helped to raise living standards, particularly during the 19th and early 20th centuries. However, the shift away from manufacturing led to significant regional disparities, particularly in the north of England, Wales, and Scotland, where traditional industries once thrived. In 2022, for example, the unemployment rate in parts of northern England was 5.2%, compared to just 3.2% in the southeast, reflecting the long-term impact of deindustrialization. Today, policies aimed at leveling up these regions are central to addressing these disparities. The Industrial Revolution's legacy continues to shape the British economy, influencing everything from labor markets to regional development strategies. The modern British economy is predominantly driven by the services sector, which accounts for around 80% of the country's GDP. The UK's service-based economy is centered in London, which is one of the world's leading financial hubs. In 2022, the financial services sector contributed approximately £174 billion to the UK economy, representing around 8.3% of total economic output. Other key service industries include healthcare, education, tourism, and retail. The healthcare sector, largely dominated by the National Health Service, NHS, is a major employer, providing over 1.5 million jobs. Additionally, the creative industries, such as media, entertainment, and advertising, contributed £115.9 billion to the economy in 2021. The UK's extensive higher education system, with prestigious institutions like Oxford and Cambridge, also makes a significant impact, drawing in international students and supporting research-driven industries. Although manufacturing's share of the British economy has declined since the mid-20th century, it remains a critical component in certain high-value sectors. In 2023, manufacturing contributed around 9% of GDP, with industries such as aerospace, automotive, and pharmaceuticals leading the way. The UK's aerospace sector is the second largest in the world, employing over 111,000 people and generating revenues of £33.9 billion annually. Similarly, the automotive industry, led by global brands like Jaguar Land Rover and Rolls-Royce, produced over 850,000 vehicles in 2022, contributing around £67 billion to the economy. Innovation plays a key role in maintaining competitiveness in manufacturing. For instance, the UK government has been investing heavily in green technologies and advanced manufacturing techniques, such as automation and AI, to boost productivity and meet environmental goals, including net zero carbon emissions by 2050. Small and medium-sized enterprises, SMEs, and startups are vital to the UK economy, providing employment and driving innovation. SMEs account for 99.9% of the UK's business population, employing 16.4 million people and generating £2.3 trillion in turnover as of 2022. The UK has also developed a thriving startup ecosystem, particularly in technology, finance, and digital services. London is home to some of the largest tech startup hubs in Europe, and in 2022, UK tech startups attracted £29.4 billion in venture capital investment, making it the largest recipient of tech funding in Europe. The government has introduced initiatives such as the Startup Loan Scheme and enterprise investment scheme to support these businesses, helping them scale and contribute to economic growth. SMEs and startups are seen as key to boosting productivity and driving regional economic development across the UK, especially in areas where larger industries have declined. International trade has long been a cornerstone of the British economy, given the UK's history as a global trading nation. As of 2023, the UK is the 10th largest exporter and 5th largest importer of goods and services in the world. Trade contributes significantly to the country's economic activity, with exports accounting for approximately 30% of GDP. Key exports include machinery, vehicles, pharmaceuticals, and financial services, while major import partners include the European Union, EU, the United States, and China. In 2022, UK exports amounted to £731 billion, with the services sector, particularly financial and professional services, playing a crucial role, contributing £343 billion. London's financial services alone generated a trade surplus of £66 billion in 2022. The UK's global trade networks continue to evolve as the country navigates the changing dynamics of globalization, digital trade, and shifting supply chains. The impact of Brexit has been significant on the UK's trade patterns and relationships. After officially leaving the EU in 2020, the UK exited the EU's Single Market and Customs Union, which resulted in increased trade barriers such as customs checks, regulatory divergence, and tariffs on certain goods. This led to a noticeable dip in trade with EU countries. For instance, UK exports to the EU dropped by 15% in the first year after Brexit. In 2022, the EU still accounted for 42% of UK exports and 45% of imports, but trade volumes with non-EU countries, particularly the US and China, have grown in importance. The Office for Budget Responsibility estimated that Brexit would reduce the UK's long-term GDP by around 4%. Businesses, particularly in sectors like manufacturing and agriculture, have faced increased costs and delays due to new trading arrangements, leading to a reorientation of supply chains and adjustments in trade practices. In response to Brexit, the UK has been actively seeking to establish new trade deals and strengthen existing relationships outside the EU. In 2021, the UK signed a trade deal with the European Union, the Trade and Cooperation Agreement, which allows for tariff-free trade on most goods, though it does not cover services comprehensively. Beyond the EU, the UK has pursued agreements with major global economies, including trade deals with Japan, Australia, and New Zealand, as well as joining the Comprehensive and Progressive Agreement for Trans-Pacific Partnership, CPTP, in 2023. The UK is also in negotiations for a free trade agreement with the United States, although a deal has not yet been finalized. These efforts are aimed at diversifying trade partnerships and reducing reliance on the EU, while positioning the UK as a global trading nation. In 2022, UK trade deals covered nearly 70% of its total trade, and the government continues to push for more agreements to boost international commerce. The financial sector is a cornerstone of the British economy, contributing significantly to GDP, employment, and tax revenues. As of 2023, the financial services sector generated around £174 billion in economic output, accounting for 8.3% of the UK's total GDP. The sector is also a key source of employment, with over 1.1 million people working in banking, insurance, asset management, and related industries. The UK's financial sector is renowned for its diversity, encompassing everything from traditional banking and insurance to cutting-edge fintech. In 2022, the UK attracted £29.4 billion in fintech investment, making it the top destination for tech-driven financial services in Europe. The financial sector's international focus and adaptability have helped it maintain resilience in the face of challenges such as Brexit and the COVID-19 pandemic, ensuring it remains a critical part of the modern British economy. London, in particular, stands as one of the most important financial centers in the world, rivaling New York and Hong Kong. The City of London, home to the London Stock Exchange, Lloyd's of London, and the Bank of England, is a hub for global banking, insurance, and asset management. The London Stock Exchange, one of the oldest in the world, had a market capitalization of over £4.3 trillion as of 2022, making it one of the largest exchanges globally. Additionally, the UK's dominance in foreign exchange markets is significant, with London accounting for over 43% of global currency trading in 2021. The capital also houses a growing number of fintech companies, with nearly 2,500 fintech firms operating across the UK, the majority based in London. Despite uncertainties from Brexit, London's unique legal, regulatory, and cultural environment continues to attract businesses and talent from around the globe. The UK's banking and finance sector has evolved significantly over the past few decades, particularly in response to the 2008 global financial crisis. Historically, the UK has been a leader in developing financial instruments and services, from the early days of stock trading to modern-day innovations in digital banking. The 2008 crisis, however, exposed vulnerabilities in the financial system, leading to widespread reforms. The UK government implemented the Financial Services Act 2012, which introduced stricter oversight through the creation of the Financial Conduct Authority, FCA, and the Prudential Regulation Authority, PRA. These bodies work to ensure financial stability, protect consumers, and regulate firms. In recent years, the UK has also led the charge in creating a more open and transparent financial system, exemplified by the introduction of open banking in 2018, which gives consumers greater control over their financial data. The UK's regulatory framework continues to adapt, particularly in areas such as cryptocurrency, where authorities like the FCA are increasingly focused on addressing the risks associated with emerging financial technologies. Financial regulation has become a key area of focus as the UK navigates post-Brexit challenges and the changing global landscape. Following its exit from the European Union, the UK government has sought to balance maintaining high regulatory standards with the need for greater flexibility to boost its competitiveness as a global financial center. In 2021, the UK government introduced the Financial Services and Markets Bill, designed to overhaul the UK's regulatory framework to ensure it remains competitive in the post-Brexit world. Key areas of reform include strengthening the country's leadership in green finance, promoting innovation in fintech, and ensuring that regulations are proportionate while safeguarding stability. In 2022, the Bank of England and the FCA also introduced new rules aimed at improving the resilience of the UK's financial system, particularly in response to growing risks from climate change and cyber threats. These ongoing reforms reflect the financial sector's pivotal role in shaping the future of the UK economy. The UK government plays a central role in steering the economy through its fiscal policies, which involve managing public revenue and expenditure to achieve economic stability and growth. Fiscal policy is primarily implemented through the government's annual budget, which outlines its tax and spending plans. In 2023, the government faced significant fiscal challenges as it sought to manage a national debt exceeding £2.5 trillion, approximately 100% of GDP. In response to the economic fallout from Brexit, the COVID-19 pandemic, and inflationary pressures, the UK government has adopted measures to support growth while addressing the fiscal deficit. For instance, during the pandemic, the government introduced the furlough scheme, providing over £70 billion in support to businesses and workers. The 2023 budget focused on reducing inflation and supporting investment in key areas such as infrastructure, health, and education, while increasing taxes, such as the corporation tax rise from 19% to 25%, to help balance the budget. Monetary policy in the UK is managed by the Bank of England, which plays a critical role in controlling inflation, stabilizing the currency, and promoting economic growth. The Bank of England's main tool is the manipulation of interest rates to manage inflation and influence economic activity. In 2022 and 2023, the bank raised interest rates several times in response to rising inflation, which hit a 40-year high of 10.1% in September 2022, driven by supply chain disruptions and the energy crisis following the Russian invasion of Ukraine. The Bank of England also manages the country's money supply through measures such as quantitative easing, QE, which was implemented during the pandemic to stimulate the economy by purchasing government bonds. In 2020, the bank injected £450 billion through QE. The Monetary Policy Committee, MPC, meets regularly to assess economic conditions and set interest rates accordingly, with the primary target being to keep inflation at 2%. Recent policy has focused on stabilizing inflation without stifling economic growth, as the UK grapples with global economic uncertainty. Public sector spending and investment are crucial to the functioning of the UK economy, with the government funding critical sectors such as healthcare, education, defense, and infrastructure. In 2022 to 2023, total government expenditure reached £1.1 trillion, representing about 44% of GDP. The National Health Service, NHS, is one of the largest areas of public expenditure, with over £180 billion allocated in 2022 to 2023, reflecting the government's commitment to healthcare. Investments in infrastructure have also been a key priority, particularly in projects aimed at boosting productivity and leveling up regional disparities. For instance, the government has committed £96 billion to the Integrated Rail Plan, which aims to improve connectivity in the North and Midlands. Additionally, the UK government is investing heavily in green energy, with a pledge to spend £26 billion over the next decade to support the transition to net zero emissions by 2050. Public sector investment in education, particularly in research and development, is also a priority, with £39.8 billion earmarked for education in 2022 to 2023, aimed at improving skills and innovation to support long-term economic growth. The government's spending and investment decisions are integral to shaping the future trajectory of the UK economy. The demographics of the UK workforce have been shifting over the past few decades, reflecting broader social and economic changes. As of 2023, the UK labour market is increasingly diverse in terms of age, gender, and ethnicity. The aging population is one of the most significant trends, with the number of people aged 65 and over expected to rise from 12.3 million in 2022 to nearly 17 million by 2040. This has led to a growing proportion of older workers in the labor force, with the employment rate for those aged 50 to 64 rising to 72.5% in 2023. Meanwhile, women's participation in the labor market has also increased, reaching 72.3% in 2022, driven by changes in social norms and economic necessity. However, disparities remain, particularly for ethnic minority groups, who generally face higher unemployment rates and lower wages compared to their white counterparts. In 2021, the unemployment rate for black workers was 8.5%, compared to 3.4% for white workers. Employment rates in the UK have been relatively stable over the past few years, despite challenges from Brexit and the COVID-19 pandemic. In 2023, the UK's employment rate stood at 76%, slightly below the pre-pandemic level of 76.6% in early 2020. Unemployment, meanwhile, dropped to 4.2% in mid-2023 after peaking at 5.2% during the height of the pandemic in 2020. The UK's flexible labour market, characterized by part-time work, self-employment, and temporary contracts, has contributed to its ability to maintain relatively low unemployment rates, even during periods of economic stress. However, the labor market also faces significant structural challenges. The Office for National Statistics reported over 1 million job vacancies as of mid-2023, reflecting persistent skills shortages in key sectors such as healthcare, IT, and construction. Wages have been slow to recover, with real earnings falling due to inflationary pressures, leading to a cost of living crisis for many workers, particularly in lower-paid sectors. The gig economy has become an increasingly important feature of the UK labor market, with millions of workers engaging in short-term, flexible, or freelance work. In 2022, it was estimated that around 4.4 million people in the UK, approximately 14% of the workforce, were involved in gig work, ranging from ride-sharing and food delivery to freelance digital services. This trend has been driven by the rise of digital platforms, which allow workers to find jobs and clients with greater ease. While the gig economy offers flexibility for workers, it also raises concerns about job security, income instability, and a lack of benefits such as pensions and sick pay. In response, the UK government has been examining ways to provide better protections for gig workers, with a 2021 Supreme Court ruling recognizing Uber drivers as workers entitled to minimum wage and holiday pay. Looking ahead, the UK workforce is expected to become even more flexible and technology-driven, with automation, artificial intelligence, and remote working likely to reshape employment patterns. This shift will require a renewed focus on skills development and retraining to ensure the workforce is prepared for future demands. Income inequality remains a significant challenge for the British economy, with disparities in wealth and income levels increasingly pronounced. The latest figures from the Office for National Statistics indicate that the richest 10% of households in the UK possess 45% of the nation's wealth, while the bottom 50% hold just 9%. This growing divide is particularly evident in income levels, where the richest households earn nearly 9 times more than the poorest. Factors contributing to income inequality include wage stagnation in lower-paid jobs, rising costs of living, and disparities in educational and employment opportunities. The effects of income inequality extend beyond economics, influencing social cohesion and contributing to higher rates of poverty. As of 2023, approximately 22% of children in the UK live in relative poverty, raising concerns about the long-term impact on their education and life chances. Addressing these disparities will be crucial for ensuring a fairer, more inclusive economic environment. The housing crisis is another pressing issue impacting living standards across the UK. Rapidly rising property prices, especially in cities like London, have made homeownership increasingly unattainable for many. According to the UK House Price Index, average house prices rose by 10.8% between 2020 and 2021, with the average home costing approximately £276,000 by early 2023. This surge in prices has outpaced wage growth, leading to a situation where many young people are unable to afford their own homes. Furthermore, the rental market has also seen significant increases, with rents in London rising by over 14% in 2022 alone. The crisis has resulted in a growing number of people experiencing housing insecurity, with homelessness rates rising by 2% in 2022. The government has implemented measures such as the Help to Buy scheme and initiatives to increase the supply of affordable housing, but significant challenges remain in providing adequate housing for all, especially in high-demand areas. Regional disparities continue to be a prominent challenge for the British economy, with stark differences in economic performance and opportunities between various regions. The Levelling Up agenda, introduced by the UK government, aims to address these inequalities by investing in underperforming regions, particularly in the north of England, Wales, and parts of the Midlands. For instance, in 2023, the government announced a £4.8 billion funding package for levelling up initiatives, focusing on infrastructure, education, and skills development in economically deprived areas. Despite these efforts, the gap in productivity between London and other regions remains significant, with output per hour worked in London being approximately 27% higher than in the Northeast. Additionally, unemployment rates can vary widely. As of mid-2023, the unemployment rate in the Northeast was around 5.8%, compared to just 3.2% in the Southeast. Addressing these regional disparities will require a comprehensive approach, combining targeted investments, infrastructure development, and education and skills training to ensure all regions can share in the economic prosperity of the nation. The rise of the digital economy has transformed the landscape of the British economy, leading to significant changes in how goods and services are produced and consumed. In 2023, the digital economy was estimated to contribute approximately £150 billion to the UK's GDP, accounting for about 7.3% of the total economic output. The shift towards digitalization has been accelerated by the COVID-19 pandemic, which forced many businesses to adapt to online models. E-commerce has seen tremendous growth, with online retail sales reaching £125 billion in 2022, a 20% increase from the previous year. This growth has not only affected traditional retailers, but has also given rise to new business models and opportunities across various sectors, including fintech, health tech, and edtech. The UK is now home to a vibrant ecosystem of digital businesses, with more than 1.4 million people employed in the digital sector, highlighting the importance of technology as a driver of economic growth and innovation. Tech startups and innovation clusters have emerged as key components of the UK's economy, fostering an environment where new ideas and technologies can flourish. The UK is recognized as one of the leading tech hubs in Europe, with London, Cambridge, and Manchester serving as primary innovation centers. In 2022, UK tech startups attracted a record £29.4 billion in venture capital investment, making it the largest recipient of tech funding in Europe. The Cambridge Tech Cluster, known as the Silicon Fen, has been particularly successful, housing over 1,500 companies specializing in technology and innovation, particularly in the fields of biotech and software development. Additionally, the UK government has initiated several programs to support startups, including the Startup Loan Scheme, which has provided over £500 million in funding since its inception. These initiatives aim to nurture entrepreneurship, promote innovation, and ensure that the UK remains competitive in the global technology landscape. The integration of automation and artificial intelligence, AI, into the workforce is transforming traditional job roles and enhancing productivity across various industries. As of 2023, it is estimated that around 30% of jobs in the UK could be affected by automation within the next 15 years, particularly in sectors such as manufacturing, logistics, and retail. The government has recognized the potential of AI and automation to drive economic growth, investing over £1 billion in the AI sector deal to promote research and development in this field. Companies like DeepMind and Babylon Health are leading the way in harnessing AI technologies to improve services in healthcare and data analysis. While the rise of automation brings concerns about job displacement, it also creates new opportunities for skilled workers in areas such as data science, machine learning, and robotics. The challenge for the UK will be to manage this transition effectively, ensuring that workers are equipped with the necessary skills to thrive in an increasingly automated economy. This will require a concerted effort from educational institutions, government, and industry to invest in reskilling and upskilling initiatives. The concept of the green economy has gained significant traction in the UK as policymakers, businesses, and consumers increasingly recognize the need for sustainable economic practices. The green economy encompasses a range of activities aimed at reducing environmental impacts while promoting economic growth. In 2022, the green economy was estimated to contribute approximately £199 billion to the UK's GDP, representing a growth rate of 8.7% from the previous year. Key sectors within the green economy include renewable energy, sustainable transportation, and waste management. The government has set ambitious targets, aiming for net zero carbon emissions by 2050, and the green economy is seen as essential for achieving these goals. Initiatives such as the Green Jobs Task Force have been established to facilitate job creation in green sectors, with projections suggesting that over 200,000 green jobs could be created by 2030, particularly in industries related to energy efficiency and low-carbon technologies. Environmental policies and regulations have become increasingly stringent in the UK, reflecting a commitment to sustainable development and climate action. The Environment Act 2021 introduced new frameworks for environmental governance, setting legally binding targets for air quality, water resources, and biodiversity. Additionally, the UK government has established the Office for Environmental Protection, OEP, to oversee compliance with environmental laws and hold public authorities accountable. As part of its environmental strategy, the government has pledged to reduce plastic waste, promote circular economy practices, and protect natural habitats. In 2022, the UK hosted the 26th UN Climate Change Conference, COP26, in Glasgow, where world leaders convened to discuss global climate commitments. The UK government announced a £12 billion investment package to support green initiatives, demonstrating a proactive approach to addressing climate change and fostering a more sustainable economy. The shift to renewable energy is a critical component of the UK's strategy for achieving sustainable growth and reducing carbon emissions. In 2022, renewable energy sources accounted for approximately 48% of the UK's electricity generation, surpassing fossil fuels for the first time. Wind power, particularly offshore wind, has become a significant contributor, with the UK leading the world in offshore wind capacity, reaching over 13.9 gigawatts (GW) by the end of 2022. The government aims to generate 50 GW of offshore wind energy by 2030, which could power approximately 50 million homes. Additionally, solar energy, biomass, and hydropower are playing increasingly vital roles in the UK's energy mix. The transition to renewable energy is supported by policies such as the Contracts for Difference scheme, which provides financial incentives for low-carbon energy projects. However, challenges remain in the form of energy storage, grid capacity, and the need for substantial investments in infrastructure. Addressing these challenges will be crucial to ensuring that the UK not only meets its renewable energy targets, but also establishes a resilient and sustainable energy future. The post-Brexit economic outlook for the UK presents a complex landscape shaped by new trade relationships, regulatory changes, and evolving market dynamics. Since leaving the European Union in January 2020, the UK has sought to establish its own trade agreements and frameworks. However, initial forecasts indicated that the UK's economy could shrink by 4% due to Brexit-related disruptions. As of 2023, while the economy has shown signs of resilience, particularly in sectors like technology and finance, challenges remain. The Office for Budget Responsibility projected a modest growth rate of around 1.8% for 2023, hindered by ongoing trade frictions and the adjustment to new customs regulations. The UK government is actively seeking to enhance its global trade relationships, particularly with nations such as the United States, India, and members of the Commonwealth, through negotiations of free trade agreements, FTAs, aimed at boosting exports and attracting foreign investment. The impact of global crises, such as the COVID-19 pandemic and the ongoing conflict in Ukraine, has profoundly influenced the trajectory of the British economy. The pandemic led to unprecedented disruptions, with GDP contracting by 9.4% in 2020, the largest decline since records began. The recovery, however, has been uneven, with sectors like hospitality and travel still struggling to return to pre-pandemic levels. The war in Ukraine has further complicated the economic landscape, resulting in skyrocketing energy prices and supply chain disruptions. In 2022, inflation reached a peak of 10.1%, driven primarily by rising energy costs and supply chain issues, which prompted the Bank of England to raise interest rates in a bid to curb inflationary pressures. As the economy grapples with these challenges, there is an increasing focus on building resilience through diversification and innovation, ensuring that the UK is better equipped to withstand future shocks. Looking ahead, strategic visions for growth and innovation are crucial for positioning the UK as a leader in the global economy. The government's Build Back Better strategy emphasizes investing in infrastructure, skills development, and green technologies to drive long-term economic growth. Initiatives such as the UK's 10-point plan for a green industrial revolution outline a roadmap for creating up to 250,000 jobs by 2030 through investments in clean energy, transport, and innovation. Moreover, the government has committed to enhancing digital infrastructure, aiming for nationwide gigabit broadband coverage by 2025 to support the digital economy's growth. By fostering collaboration between businesses, academia, and public institutions, the UK is aiming to create a robust ecosystem that encourages innovation and attracts investment in emerging technologies such as artificial intelligence, biotechnology, and sustainable practices. As these strategies unfold, the focus will be on ensuring that growth is not only sustainable but also inclusive, addressing regional disparities and supporting the workforce in adapting to the changing economic landscape.